Hello, I'm Jean Gray, publisher of American Entrepreneurship Today. Welcome to this special video tutorial from our Experience Voices podcast series. One of the questions I hear most often from founders is, how do I actually get the money to build my startup? Welcome to our tutorial on one of the most critical milestones in a founder's journey, determining if your startup is truly VC ready. Not every great business is a fit for venture capital, and knowing where you stand before you hit the fundraising trail can save you months of frustration. Let's break down the framework VCs use to evaluate your potential. First, we have to look at the venture scale thesis. VCs aren't just looking for a profitable business. They are looking for power law winners. To truly understand if you are VC ready, you have to understand the math of the power law. Venture capital doesn't follow a normal distribution. It follows a winner-take-all model. In a typical portfolio of 20 startups, a VC expects 15 to struggle or fail entirely. They are searching for the one power law winner. That single breakout success, like an Uber or an Airbnb, that returns more capital than the rest of the portfolio combined. When an investor asks about your exit potential, they aren't being greedy. They are checking to see if your business has the ceiling required to be that fund returner. If your business model hits a natural plateau at $10 or $20 million, you might have a fantastic company, but you don't have a power law winner. To be VC ready, you must demonstrate that with the right capital, your growth potential is effectively uncapped. Ask yourself, can this company realistically return 10 times the initial investment? To do that, you need a total addressable market, or TAM, of at least $1 billion. If your business relies on linear growth, meaning you have to double your staff just to double your revenue, you might have a great lifestyle business, but you don't have a venture scale one. VCs want to see scalability and a clear path to an exit or IPO. Next is product market fit. This is the moment the market starts pulling the product out of you rather than you pushing it onto them. Look at your retention. Do users stick around after 90 days? Is your growth organic, or are you paying for every single lead? A VC-ready startup passes the must-have test. If your product disappeared tomorrow, your customers should feel a genuine void in their operations. Documentation of these feedback loops is key. Now let's look at the numbers. As you can see in the chart, VCs are obsessed with the angle of your growth curve. We're looking for compounding monthly recurring revenue, ideally 15 to 20% growth month over month. But growth at all costs is a red flag. You need healthy unit economics, a lifetime value to CAC ratio of at least 3 to 1. If your churn is low and your sales cycle is predictable, you have an engine that is ready for the high-octane fuel. At the early stage, investors are betting on the jockey, not the horse. They look for founder market fit. Do you have a unique, unfair advantage or deep domain expertise that others lack? They are also looking for technical velocity. How fast can your team ship updates? Most importantly, remain coachable. VCs want founders who can defend their vision but pivot quickly when the data proves them wrong. Before you take the money, you have to prove you can manage it. That means having a clean cap table with no messy legal disputes and a virtual data room that is organized and ready for due diligence. Investors want to see that you are incorporated correctly, usually as a Delaware C Corp, and that you have a firm grasp on your burn rate and remaining runway. Maturity in your back office operations signals that you are a professional, not a hobbyist. The biggest mistake founders make is asking money to figure things out. VC money should be gasoline on an existing fire. You need a rock-solid plan for exactly what that capital will achieve. Will it hire your next 3 key engineers? Will it allow you to scale from 1,000 to 10,000 users? If you can't articulate exactly how the funding gets you to the next valuation milestone, you aren't ready to ask for it. To wrap up, perform a final self-audit. Is your market massive? Is your product sticky? Is your team uniquely qualified? And is your traction moving up and to the right? If you can check at least 3 of these 4 boxes, you're likely ready for an angel or seed round. If you have all 4, you are officially VC ready. Now it's time to polish that deck and start the hunt. Good luck. I hope you found our funding tutorial helpful. Please like, share, and subscribe so we may bring more content supporting your entrepreneurial journey. Check out our full Experience Voices podcast series. Look for more segments that help you start, fund, and grow your business.